Welcome to episode 29 of our macroeconomics season. Today, we are focusing on the heartbeat of the financial world, economic cycles. We will explore why expansions eventually die, why recessions finally reach their end, and the critical reason why most investors manage to miss both of these massive transitions. Understanding the rhythm of the economy is the difference between being a spectator and a participant in the wealth-building process. To understand why cycles matter, consider that the same company can be a hero or a disaster depending on when you enter the market. Look at Caterpillar. In May 2008, it traded at $85. By March 2009, it collapsed to $23, a 73% wipeout before climbing to $170 by 21. The company didn't change, but the cycle did. This episode provides the essential framework to judge the tide, rather than just staring at your own boat, ensuring you aren't blindsided by the broader economic environment. The cost of ignoring these cycles is immense. Between December 2007 and June 2009, the Great Recession destroyed $19.2 trillion in United States household wealth. The S&P 500 plunged 57% from its peak to its trough. 8.7 million jobs vanished, and 3.8 million homes were lost to foreclosure. Yet, that entire recession lasted only 18 months. The damage was catastrophic and entirely predictable in hindsight. So today we are learning what to look for before the storm arrives, rather than analyzing the wreckage after it has already passed. Every economic cycle moves through four distinct phases. We start with expansion, where GDP rises and jobs are plentiful. Then comes the peak, where growth maxes out, inflation accelerates, and the Federal Reserve tightens policy. Next is the recession, or contraction, where GDP falls and spending freezes. Finally, we reach the trough, the bottom where pessimism is at its highest, but the seeds of recovery are already planted. Since World War II, expansions have averaged 64 months, while contractions lasted just over 10 months. Expansion is the economy's default state, but recessions, while rare, capture all the headlines. During the expansion phase, real GDP grows, non-farm payrolls rise, and industrial production climbs. Consumer confidence drives spending and credit flows freely. Take the 2009 to 2020 expansion, the longest in history at 128 months. Unemployment fell from 10% to 3.5%, and shale oil production surged from 5 million to over 12 million barrels per day. The average annual real GDP growth reached 2.3%. This is the period where cyclical sectors like technology, financials, and consumer discretionary typically outperform as the economy operates at full throttle. When the engine overheats, we enter the peak. Demand outstrips supply, causing inflation to accelerate as wages and prices feed off each other. The Federal Reserve usually responds by raising interest rates to cool things down. Interestingly, financials and energy sectors often perform best here because banks benefit from wider interest rate spreads and commodity prices remain elevated. This is the hardest phase to identify in real time because every indicator looks strong. Unemployment is low and earnings are rising. Yet, this is exactly when the risk-reward ratio for an investor begins to deteriorate significantly. A recession is a significant decline in economic activity lasting more than a few months. The NBER looks for three criteria: depth, diffusion, and duration. Contrary to popular belief, 2 consecutive quarters of negative GDP growth are neither required nor sufficient. The 2001 recession had only 1 quarter of slight decline at negative 0.3%. During these contractions, investors usually rotate into defensive sectors like healthcare, consumer staples, and utilities for stability. As the economy shrinks, unemployment rises and corporate earnings contract, making credit much harder to obtain. The trough is the turning point where the economy stops contracting and begins to expand again. By definition, it is the last month of the recession. Identifying this in real time is incredibly difficult because the news is still universally terrible. However, the stock market typically bottoms 3 to 6 months before the economic trough actually occurs. Real estate and industrials are often the first to recover. Consider that the April 2020 trough arrived just 2 months after the February peak, making it the shortest recession in history, even though few investors were willing to buy during the panic of March. The National Bureau of Economic Research, or NBER, is the official scorekeeper for the United States. Their Business Cycle Dating Committee examines multiple monthly indicators, including non-farm payrolls, real personal income, consumption, industrial production, and trade sales. They place the most weight on employment and income when determining the official dates of a peak or a trough. Because they wait for extensive data verification, these decisions are often announced a year or more after the turning point actually occurred. For example, they officially declared the February 2020 peak and the April 2020 trough long after the fact. The Great Depression, lasting from 1929 to 1933, remains the defining catastrophe of the 20th century. The recession lasted 43 months, with real GDP contracting by 26.7%. Unemployment hit 24.9%, and over 9,000 banks failed. World trade collapsed by 65%. This crisis was so severe it birthed the New Deal, Social Security, the SEC, and the FDIC. It fundamentally changed the relationship between the government and the economy, and true recovery did not arrive until massive military spending during World War II finally restored full employment. The 1973 oil shock, lasting until March 1975, introduced the term stagflation to the world. The OPEC oil embargo caused prices to quadruple, triggering the worst downturn since the Depression. The recession lasted 16 months, with real GDP falling 3.2% and unemployment reaching 9%. The S&P 500 lost 48% of its value. This shattered the post-war consensus that policymakers could easily trade off unemployment for lower inflation, proving that supply shocks could break the traditional relationship between economic growth and price levels. The Volcker Recession of July 1981 to November 1982 was a deliberate act by the Federal Reserve. Chairman Paul Volcker raised the federal funds rate to 20% to crush runaway inflation that had peaked at 14.8%. The recession lasted 16 months, with unemployment hitting 10.8%, the highest since the Great Depression. While manufacturing was devastated, inflation fell to 3.2%. This was a calculated sacrifice of short-term pain for long-term stability, establishing the Fed's credibility and setting the stage for the decades of growth that followed. The dot-com bust of 2001 saw the technology bubble burst, erasing $5 trillion in NASDAQ market value. The recession itself was short, lasting 8 months, with GDP falling only 0.3%. However, the bear market was brutal for tech stocks, with companies like Pets.com becoming symbols of excess. The September 11th attacks further deepened the downturn. In response, the Federal Reserve slashed rates to 1%, which inadvertently planted the seeds for the housing bubble that would trigger the next major crisis. Peak unemployment reached 6.3%, teaching us that asset bubbles can cause more market damage than economic damage. The Great Recession of December 2007 to June 2009 was fueled by subprime mortgages and complex instruments like credit default swaps. Real GDP fell 4.3%, unemployment reached 10%, and the S&P 500 dropped 57%. The collapse of Lehman Brothers and the bailout of AIG defined the era. The government response was massive, including $700 billion in bank bailouts, quantitative easing, and a $787 billion stimulus. 8.7 million jobs were lost, and median household wealth did not recover for an entire decade. The COVID-19 recession was the shortest and sharpest in history, lasting just 2 months. When shutdowns began in March 2020, 22 million jobs vanished in weeks. GDP fell at an annualized rate of 31.2% in the second quarter. The S&P 500 dropped 34% in 5 weeks. Congress responded with over $5 trillion in relief, including the CARES Act and stimulus checks. While the economy snapped back, this fiscal response contributed to the highest inflation since the early 80s, peaking at 9.1% in June 2022. Economic expansions have grown longer over time. The 2009 to 2020 expansion lasted 128 months, beating the previous record of 120 months. Before World War II, expansions averaged only 27 months, but since 1945, they have averaged over 64 months. This reflects improved monetary policy and automatic fiscal stabilizers like unemployment insurance. While the economy has experienced 23 recessions since 1900, the frequency has dropped, with only 8 recessions occurring since 1950. We are seeing more stability and longer periods of growth in the modern era. Different sectors dominate different phases of the cycle. During expansion, technology, financials, and consumer discretionary lead. At the peak, financials and energy stay strong as rates and commodity prices remain elevated. During contraction, investors rotate to defensive sectors like healthcare, consumer staples, and utilities, which sell essential goods. In the early recovery, real estate and industrials typically lead the way. The key insight is not to time every rotation perfectly, but to understand why your specific holdings behave differently as the cycle turns, allowing you to adjust your strategy according to the broader environment. Defensive stocks are your champions during a recession. During the 2008 crash, while the market plummeted, Walmart stock actually rose 18%. Other companies like McDonald's, Coca-Cola, Procter & Gamble, Johnson & Johnson, and PepsiCo outperformed because they sell essential products that people buy regardless of the economy. These companies maintain strong balance sheets and keep raising dividends even when others are failing. Dollar General also thrives as consumers trade down to save money. This defensive playbook is not about excitement. It is about survival when cyclical companies see their revenues cut in half. Cyclical companies amplify the economic cycle because they sell discretionary goods that people stop buying during downturns. Boeing fell 71% during the Great Recession, and Deere & Company dropped from $95 to $29 before eventually climbing to $450. Home builders like D.R. Horton saw their stock fall from $27 to $5 before rising to $110. These companies are not necessarily poorly managed. Their revenues are simply tied to investment decisions that freeze during recessions and accelerate during booms. To own these, you need either perfect timing or a long-term horizon that spans the full cycle. The Conference Board's Leading Economic Index, or LEI, uses 10 components to predict turning points about 7 months in advance. These include manufacturing hours, unemployment claims, new orders, building permits, the S&P 500, credit indices, and interest rate spreads. The rule of thumb is the 3 Ds. Recession risk rises significantly when the 6-month diffusion index falls to 50 or below and the 6-month growth rate drops below -4.1%. This index provides a mathematical way to look forward rather than just reacting to the news of the day. Where do we stand as of mid-2026? We have been in expansion since April 2020, a period of over 74 months. Real GDP grew 2.6% in 24, and while growth slowed in 25, the CBO forecasts a rebound to 1.8% in 26. Unemployment has risen to 4.3%, and inflation remains above the Fed's 2% target. The LEI declined throughout 25 but has shown 2 consecutive monthly increases, with a 6-month growth rate of -0.3%. This is well above the recession threshold, suggesting the expansion continues. To monitor the current environment, watch 3 signals. First, track the LEI's 6-month growth rate and diffusion index for the 3 Ds signal. Second, keep an eye on initial unemployment claims. A 4-week moving average above 250,000 has preceded every post-war recession. Third, watch the yield curve spread between 10-year treasuries and the federal funds rate. A deeply inverted curve has preceded every recession since 1955. Currently, the yield curve has normalized and the LEI is improving, suggesting that while growth is slower, we are not yet in a recessionary state. The cycle mindset is about context, not clockwork. Economic cycles do not run on a set schedule, and the phases are only easy to identify in the rearview mirror. What matters is knowing which sectors amplify the cycle and which ones dampen it. Remember that the stock market leads the economy by 3 to 6 months. You do not need to be a perfect market timer to survive. You just need to build a portfolio that can withstand the current phase while keeping you positioned for the next one. Stay disciplined, stay observant, and don't let market noise distract you from the trend. In our next episode, we are diving deep into monetary policy and the Federal Reserve. We will cover the Fed's 3 core pillars: the specific tools they use from interest rates to quantitative easing and tightening, and exactly how the markets react when the FOMC speaks. Understanding the Fed is the final piece of the puzzle for mastering the macro environment. I will see you in episode 30.